Hello everyone, welcome back to Market Structure Masterclass. In today's video, we're going to talk about ICT Market Structure Advanced. So let's start with the market narrative. What is the current market narrative? Understand that everything you do on the lower time frames must be based on the context of the higher time frames. The main goal we're striving towards on the higher time frames is to identify where the banks and financial institutions want to bring price. Banks and financial institutions operate from a long-term perspective. We are then navigating from that perspective with all the details found in an intermediate term perspective and a short term perspective. This gives us all the details of price action we need to find a plethora of repeatable, one-directional trading setups. Finding a narrative from the long-term perspective should not be hard, it should be obvious. The financial markets are only doing two things. It's either hunting a liquidity pool, or it's either rebalancing an imbalance. It's your job to determine what's currently going on from the long-term perspective so you can align your setups on the lower time frames to fit that narrative. And failing to do so would be considered low probability trading. So once again, finding a narrative should not be hard, it should be obvious. And you'll see that there'll either be an imbalance nearby, or there'll either be a liquidity pool nearby that just jumps right at you. And this becomes a lot more easier when you remove all the indicators from your chart, or anything covering the details of candlesticks such as moving averages. You'll see that price is either trying to seek an old imbalance, or it's trying to seek a liquidity pool. That's it. So it's your job to determine which is more likely to occur. And you just got to figure out, okay, what's the closest one? And use the closest one as your drawn liquidity and bias. And if, let's say, the closest one is this imbalance, well, that's your drawn liquidity. And then let's say the imbalance starts to break, so the imbalance is not holding anymore, then you can aim for the sell side liquidity below the imbalance. So that would be your next objective, your next drawn liquidity. And let's say the sell side liquidity pool, we got a clean close below, then look more to the left. In the past, is there any other imbalances where price is more likely to go and fill? Or is there more sell-side liquidity? You keep doing the same thing over and over and over again until you get some signs of, alright, the trend is probably going to stop. So let's get into this. So here we have a daily chart. And narrative on the daily chart here is not that clear. You see this imbalance over here. Price just overshot the imbalance. So where's the next objective? Well, we have this order block here. We have this imbalance here. And then you have these sort of clean highs here, okay? But it's just not very clear to us at the moment. So what you want to do is shift up a scale. So if the daily chart's not clear, you can shift up a scale to the weekly chart. So now we can see that the narrative on the weekly chart is very clear, and we're going to use this as our long-term perspective. Then we can go back down into the daily chart, and it will just be a lot more clear when we blend those two perspectives together. So let's start with what was the previous story. What was the story behind price here? What happened previously? So this is what you want to do. You want to walk through what price has recently done and where it's most likely going to head next. Okay? So what has price previously done? Well, we have a price range here from this high to this low. My bad, I'm supposed to draw the range from this low to here. So imagine that it's retracing within this range here. Okay, so it'd still be in a premium, but I just used the wrong swing low. Nonetheless, it's still the same. So this is the previous range. Price traded back into a premium and reacted off this fair value gap on the weekly chart. That set the stage for 1, 2, 3, 4 bearish weekly candles. Where is it aiming towards? Well, it aimed towards this bullish weekly fair value gap here. Okay, so that was one potential draw on liquidity. And what if that breaks? Okay, if this imbalance breaks, then we can start aiming for the sell side liquidity below here, which is external range liquidity. So this is internal range liquidity because it's inside of this range. External range liquidity is outside of the range, which is the most extreme prices. So you can see here, we've reacted off a previous weekly bearish fair value gap. We've had displacement on downside, breaking this weekly bullish fair value gap. So what's next? So we can see that with institutional sponsorship as well, we can see that resistance levels are holding. If we look to the left, all resistance levels are holding. We can see that supports here are breaking. So supports breaking, resistance holding. So that just tells us that if price hits another resistance level, then that resistance level is going to hold. And after that resistance level becomes active, then we're going to aim for the next support level, and we're going to anticipate that support level to break. So since in the previous chart we've already rebalanced this old imbalance, the next objective of price is to hunt sell side liquidity. So you just want to take it step by step and follow the trend. You don't want to be playing against the trend on the weekly chart, because these trends are set in stone for a long time. If you look at this trend up higher, you can see that this was an entire year worth of bullish trend. And you can see this trend lower, this was also an entire year of bullish trend. So you don't want to be calling tops and bottoms, especially on the weekly chart. You want to be sticking with the narrative, which is resistance holding, supports breaking. So now that we found the next narrative, which is hunting the sell side liquidity here, how are we going to get there? Alright, we don't want to be chasing it down there, because it's pretty obvious that it's going to go down there. But when price moves, it walks. It walks with up candles and down candles, up candles and down candles. So if it wants to walk over here, we can pretty much join that move with walking up, then taking a step down towards that sell side liquidity. So how are we going to get there? Well, we must find a key resistance level from a long-term perspective that would propel us down to that area. So what's the current price range? We have this high to this low, and we have this volume imbalance, which is essentially is a gap. So that is an area that could send us down towards sell side liquidity. Okay. So now we're going to blend both the weekly and daily chart together. Okay. So now we can see that with the context on the weekly chart, the daily becomes really clear and we have clarity in our trading. How do we have more clarity? Well, we have a dealing range to work within. This high to this low. We don't want to be looking for sells in a discount market where it's extremely cheap. We have a target for price to draw towards, the sell side liquidity. And we have a resistance level from the weekly we can refine on the daily. So you can see that this bottom end of the ICT volume balance, it's still in a discount market. So we want to make sure that we could refine that on the daily chart because it has more detail than the weekly chart. We want to refine it so we can make sure that's in a premium. So how can we do that? Well, price is already reacting off the weekly volume balance, but it's not in the premium yet. This is when you want to look within the weekly levels range, but define it to a daily level. So you can see this is the high of that volume imbalance, and this is the low of that volume imbalance. Okay, what do we have inside of that range? We have this old high, right? So if you remember the previous episodes, that internal range liquidity pools such as this, a swing high within a range, can become a resistance level. So we can breach that into a premium condition here and dig deeper into that ICT volume imbalance. Okay, that will act as a resistance level in itself. So there's an internal range liquidity pool within the volume imbalance, and we're in premium conditions. We now have a narrative to work within the lower time frames. So if you remember the first slide, we said everything you do on the lower time frames must be based on the context of the higher time frames. Now we have context to work within on the lower time frames. We have a nice level we can work off. We have a level that price wants to draw towards. That is narrative. Okay, so every time we go into lower time frames now, that is going to govern every decision we do. Before we get to the draw on liquidity, we will also have short-term targets. So this would be old lows here, or older blocks and lows. And these are just short-term targets because we know that price is not going to go from this high to the sell side liquidity pool in one move. It's not going to have a flash crash. We know that there's going to be up days and down days, up days and down days. So these short-term targets are what we want to aim for as objectives for our style of trading, such as one shot, one kill. Okay, one shot, one kill is basically 5 days of trading, but if you refine that down, it's actually 3 days of trading. Looking for a trade on Monday, Tuesday, Wednesday. Those are pretty much when you can look for trades on one shot, one kill. So that would be basically 3 candles, and this would be a perfect objective for one shot, one kill. You're only looking for 75 pips. Or day trading, right? This short-term target will be your bias for the week, and then the next week you aim for this one. The next week after that you aim for this low here. And since they're opposing our narrative, we want the market to trade down towards sell side liquidity here. We expect these short-term targets just to break. Okay, so we expect them to break and offer a retracement, or just close below and just completely keep sliding off towards this sell side liquidity here. Nonetheless, this is how you find partials. Okay, so you just want to be having a draw on liquidity and short-term targets where you can basically trim off a position or bias for a week. And you can see here, since it's opposing the parent order flow here, we expect them to break. Market goes into a little consolidation and just continue to trend towards our sell side liquidity. And we can see that the majority of the candles are down days as opposed to up days. Okay, so now let's get into classifying swing points. So before we get into classifying swing points, this is a brief overview on swing points. Okay, so swing high is a 3-bar candlestick pattern, and the fourth one is going to be basically like willingness. So like it wants to move in the swing highs direction. So you'll see a 3-bar candlestick pattern, and then the fourth one would be willingness to drop lower. Swing low is the same exact thing. Okay, so you have 1, 2, 3 candlesticks. The third one's going to close above this. That would confirm the swing. And you want to see the fourth one have some follow through up. Okay, so same thing for the swing high. You have 1, 2, 3 candles. You want the third one to close below the first one, and then you want to see the fourth one have some follow through, such as willingness to drop lower. So now that you understand swing highs and swing lows, it's time to classify swing points. So when I talk about classifying swing points, it's basically like framing long-term highs, long-term lows, intermediate-term highs, intermediate-term lows, or short-term highs, short-term lows. So you need to put them in a category, and this is what makes ICT Advanced Market Structure technical science. So before you can start classifying swing highs and swing lows, you need to have a narrative and terminus. So you need a source of price to move down, and you need a target. Then you need to understand swing highs, swing lows, which we just covered. And next, you need to understand rebalancing imbalances. So if you don't have proper understanding of imbalances, then you're going to have a hard time identifying rebalance intermediate term highs. So you need to know what those are. The narrative and the terminus gives us context behind the structure we're identifying. So if this is the source and this is terminus, terminus means where price is going to end. Okay, as it could be a short-term target, such as those previous swing lows, or it could be the draw on liquidity. Okay, basically where we're going to end either the week or where we're going to end the day. Once you have that, you can start classifying all these little peaks and troughs towards that point. And you can label this one as a long-term high, intermediate-term high, long-term low, yada yada yada, right? So you could start classifying swing points more clearly. The structure of price, you can classify it with narrative and terminus. Otherwise, you're just taking a shot in the dark. Imagine that you're identifying that as an intermediate term low. In reality, it's not. It's a short-term low before price goes up here, and you got to stop down the move. So you need to have narrative and terminus to give context. The key word here is context behind the structure you're identifying. So here's the narrative. We hit a daily liquidity pool, and it's not going to turn really clean like that, because that's classical support resistance. With liquidity pools, you're going to see the bodies of the candle sweep above it, get everyone above here bullish, buying lows, and that's what we call a purge. Okay, so once we're up there, how far do we know it can sweep? We can start looking at these figures here. There's such a thing called institutional figures, which are the 0.8 level, or the 0.2 level, or the mid-figure level. Okay, basically you can use the mid-figure level and you can project that in 10, 20, 30 grade sweeps, and that's how far price will hunt above a key liquidity pool such as this daily one. So here, this daily liquidity pool is blended pretty much with this mid-figure, so we're going to sweep that mid-figure by 30 pips. 1, 2, 3. So 500, 600, 700, 800, that's 30 pips, and that called the high. Okay, so now we're on the intermediate term perspective, and we can see, okay, is that high, this one, is that going to be confirmed? Okay, yes, because we're looking for displacement, market structure breaks, and imbalances. We see here market structure break, because this trend here is going to switch into this trend here, so that's the market structure break. We see displacement, because this move here has gaps. Okay, and we're seeing support levels break over here. Also, when price swept above the liquidity pool here, why didn't these cause the long-time highs? Well, you don't really see a market structure break. Okay, this high didn't cause a market structure break. This high did cause a market structure break, and it swept by 30 pips. with displacement as well. So the narrative will help you classify swing points. Intermediate term order flow is subordinate to parent order flow. Intermediate term swing highs and lows are linked to the parent order flow. So this level right here, this acts as the parent order flow. And all these little peaks and troughs, swing highs and swing lows, they're all linked to this source of parent order flow here. Okay? So if we know that that's the source, and that's going to be the long-term high, then we can identify all these little swing highs and swing lows pretty easily until we have a clear objective being met, which is the sell side liquidity here. And that's terminus. That's when we say, okay, right now we're just going to pause. Anything can happen over here. Might have to retrace, might close, or might just continue dumping lower. Right? We wait for more information after a market maker sell model completes, which is this low, high, low, low, or basically when it takes out a key sell side liquidity pool. Okay? Basically what we're waiting for is, does it want to see willingness to go down or reverse? Because this was a liquidity pool on the daily chart. Alright? So that is a higher time frame level. But since it's opposing the parent order flow here, source, we're expecting it to break. Okay? But if this daily level did see some sort of market structure break, then that would give us more information, wouldn't it? So now we have narrative, we have terminus. Okay? Classifying swing points becomes way more easier to do. Okay? So the narrative is from this, we're going to trade lower to here, first objective. So now we can start labeling every single swing high and swing low and how we can take action on that swing high and swing low. So without narrative, there is no context. Okay, and without context, it's hard to classify swing points. So now let's talk about how you can classify swing points, starting with long-term swing points. Long-term highs and lows are formed at a higher time frame level. We want to frame our trade setups around a higher time frame level. So with the example we've been using, it was framed off a weekly resistance level, which is the weekly fair value gap. That high that caused the displacement lower, okay, after that displacement from the weekly level, we want to classify those swing points. Okay, so the one that hit the high that hit that resistance level and caused displacement that broke previous structures, okay, we want to classify those swing points as long-term high and long-term low. Right? So after reacting to that higher time frame resistance, price will form a parent structure range. So the parent structure range would be this long-term high to this long-term low. That's the parent structural range. Basically the range that was formed after hitting that higher time frame resistance level. Now, since this long-term high reacted to the key resistance level and caused displacement that broke market structure, we're going to expect that high to hold because that's the source of the order flow. That's the source of the parent order flow. Okay? With the long-term low, we're going to expect that to break since it's opposing the parent order flow. So price in subordinate structure can just start retracing until it hits another key level. And then it's going to trade lower, and we're going to expect this low to break since it's opposing the parent order flow. Refer back to video 1 and you'll know what I mean when I talk about parent order flow. If the long-term high breaks, the level becomes invalidated. This is when you sit on your hands and wait for market structure to align with your bias again. So what if price reacted off this resistance level, formed a displacement, breaking structure here, okay? And we classify that as a long-term high. Well, if we close back above it, well, that becomes invalidated, okay? The level, this weekly resistance, pretty much becomes invalidated, and you just want to sit on your hands at that point. You don't want to have any revenge trading. It's just a cost of business, because that weekly resistance breaking could set up weeks of trend again, and sometimes losses are just a cost of business because it tells you more information of what's happening. This could have been a long-term low, and then you could have bullish weeks continuing after that, and then you could have had a 70% hit rate on those weeks, but you just took one out here. It doesn't matter, okay? Play the long run, play the long game. Don't judge your trading on one loss just because a weekly resistance level got invalidated. So once again, here we have the source of price, the weekly level. So it's basically this one, but we're gonna, since it's a liquidity pool, we have to expect it to sweep above that liquidity pool in 10, 20, 30 grade pip sweeps. Then after we see displacement here, displacement that breaks structure and support levels, okay, that gives us confirmation that that level works, okay? And this now is the long-term high, since it reacted off that higher time frame resistance level. So that's your displacement, and this is the parent structure range, okay? So this is where it started, that's your range high. This is where it ended, that's what your range low, okay? So basically, your long-term low is going to be classified when it starts retracing, okay? So did it start retracing at this low? No. Did it start retracing at this low? Yes. Okay, why did it start retracing? Well, we just took out an old low. Okay, so liquidity pools can offer retracements. Okay, don't forget that. Opposing liquidity pools can offer retracements. Notice how resistance levels hold against long-term high and support levels break. So here, long-term high is printed because we hit that higher time frame resistance level. Any opposing support levels, since we have confirmation that it wants to go down with this market structure break, any opposing support levels here, we expect them to break. This order block here, clean close below it. This order block here, with this imbalance here, and this low, we're going to close below it. So we're anticipating the long-term low to break also, since it's opposing. The long-term low basically just gave it the retracement into, first of all, back into premium from this low to this high, and also into this imbalance. So this is what it would look like on the daily chart. You have the old high here, you have the sweep above the old high, and the displacement low. But since you can't really navigate, you can't find an entry just by using the daily candles. So you need to navigate this entire move with the subordinate structure. And the subordinate structure gives us the details in price action to navigate this parent order flow. So you can see all these little details in price action. That's what we can take action on. But the daily parent order flow here doesn't give us any details to work within. So we're going to navigate that with subordinate structure. Subordinate structure is linked to the parent order flow. So you can see here, after long-term highs in, all these little peaks and troughs, okay, they're all linked to that high here, okay? So you can see how we are taking action by trading on the subordinate structure. Now let's classify intermediate swing points. when you have a long-term swing point established, which is here, you can now start finding intermediate term swing points. Alright, so it's step by step. It starts with a long-term swing point, then you start breaking it down with the context, intermediate term swing points. Long-term swing points give you the narrative for your trades, narrative and context, and intermediate term swing points give you the framework behind your trades. Right? So if this is if we're executing if our framework's off this intermediate term high, there's no reason to use this high or this high, because the framework is built on this high here. Okay? Or if we're down here already, okay, we're not going to use this high or this high, because the framework is based off this high. There are two types of intermediate term swing points. There's a classical one and a rebalanced one. Okay, so classical intermediate term high is when you have a short term high to the left, just a normal swing high, and you have that higher high, and then breaks lower. Okay, this higher high here, we're anticipating this, since this structure broke here, we're not expecting it to make another higher high, aren't we? So we're going to anticipate this to form a short term high, and overall to form an intermediate term high. Okay, and on this short term high here, that's when we want to take action. Okay, so with the context and narrative, let's imagine the context and narrative is bearish. We have a framework established here. We want to participate then on the short term high, and expecting this high not to break, since it's going to form an intermediate term high. Okay, so this move here forms the actual high. This breaks, shows us willingness that it wants to form a high, and then once this starts breaking lower, that confirms the intermediate term high. Okay, what about a rebalanced intermediate term high? For this one, you need an order balance to the left of the chart. You'll see that on the move down, there'll be an odd imbalance, and that will form the intermediate term high. So ITH for intermediate term high. Then we're gonna expect and anticipate that to be intermediate term high. So on the pullback, when it forms a short term high, okay, and it breaks down lower again, we're gonna classify that as an intermediate term high. Okay, and all of this has to be done on anticipation. Okay, so what I mean by that is, the moment you're trading, with live data, you're not gonna see this high until it's hindsight, and you say, oh, okay, that's a short-term high. You have to anticipate it to be. So you have to say, okay, that's a short-term high, that's a higher high, and that's a market structure break. So I'm expecting this one to be a short-term high, and then once price breaks down lower again, here, that confirms the intermediate term high. Okay, then it starts to fit the whole picture. Same thing here with this rebalance intermediate term high. When you're trading live data, you're not going to see this. Okay, this this high, this high. You're not going to see it. So you're just going to see price hit the imbalance, have displacement lower here, displacement lower, displacement lower to the downside. Your job is to anticipate this short-term high and trade lower. Okay, then in hindsight you'll see, okay, it is a rebalanced intermediate term high. So once again, before we continue, I want to say that you're finding these intermediate term swing points on the intermediate term perspective. Alright, so when it comes to long-term highs that is framed off the high time frame resistance level. Then when it comes to intermediate term swing points, that is framed on the chart, such as the 60-minute chart. It's framed on your intermediate term perspective, because that gives you more details. Then, with the more details, with the little peaks and troughs, the little internal range liquidity pools and bounces, you can start classifying classical intermediate term highs and rebalanced intermediate term highs. You're not going to find a rebalanced intermediate term high on a daily chart unless you're treating that daily chart as your intermediate term perspective. The key point here is intermediate. Okay, intermediate means it's on your intermediate term perspective chart. Now let's get into the significance of a rebalanced intermediate term high. Now this one shows and tells interbank traders that it's very weak. Okay, it's very weak because it couldn't have that fake out because it's just too weak. So it just showed some weakness by creating a lower high. Now, if you have been studying SMT divergences very closely, you'll see that on one correlated pair, there will be a high, and on one correlated pair, there'll be SMT divergence, because that pair was weaker, and this pair is stronger. So you're basically, in terms of structure, this tells you a lot about SMT divergences, okay, and which pair is weaker of the two correlated markets. We'll cover that more later on. So after an intermediate term swing point forms, we can anticipate a failure swing to occur. What I mean by this is, the failure swing is this. So after ICH forms here, this is the failure swing. We're expecting the failure swing to form, and we want to participate on that failure swing to trade lower. Okay, same thing here. This is the failure swing trading higher, and we want to participate on that failure swing to trade lower, to therefore print a rebalance high and complete the swing point. Failure swings are retracements for us to take action on and participate on. Since the intermediate term swing point gives us framework, the retracement has logic and reason to participate on. So in this example, I want you to focus on these intermediate term highs here and here, and all the way into our target here. Okay, we're not expecting a retracement from here all the way up to here and fill this fair value gap. No, because structure in classifying swing highs and swing lows has already told us that this intermediate term high is in, this intermediate term high is in, so the next one is here and here. Gives us framework to start looking for short-term highs to trade below to the downside here. Okay, so our framework is within this high to this low, or if we're keying off this, this is our framework from here to here. So you can see every intermediate term high that forms and the break lower, we can anticipate a failure swing as a retracement, and those retracements, these failure swings, are opportunities for us to take action on. And since the intermediate term swing point gives us framework here, the retracement has logic and reason to participate on. So here we have another intermediate term high, breaks down, takes out short-term low. Retracements of us, opportunities for us to take action on. So once again, this failure swing here, we want to take action on that short-term high. Failure swing here, we want to take action on that short-term high. So what would that look like? Well, here's a 15-minute chart, which is the short-term perspective chart. Basically a chart where you want to look for entry purposes. We'll talk about that in the next point. But here, with our framework is this intermediate term high. That's the framework. Then we have a break in MS shift right there. MS shift. Then we can start looking for an entry. So we're going to use the optimal trade entry. Okay. This high to this low hits the sweet spot, and our stop loss is above this intermediate term high, because if that intermediate term high breaks, then our analysis is basically flawed. Okay, and using the optimal trade entry strategy, we're going to target 0.5 deviations, and we're blending that with time since we're coming up to the daily candle close, which is 15-hour mark, and that sets us up for a nice 4-hour trade in the New York session. So since we have based our framework on this swing point here, it will act as a invalidation area for us. So we can say that we don't want to see price break this intermediate term high, because we're framing our trade on it. With logic and reason, this failure swing gives us the opportunity to participate on it. If this intermediate term high breaks, that's a cost of business for us, since we know that an important high has just broken. I want you guys to realize that if intermediate term highs and lows give us the framework, long-term highs and lows give us the narrative. If an intermediate term high breaks, that can give us clues and more insights on what's going to happen next for the long-term perspective. Okay? Because you're going to get these clues on an intermediate term perspective a lot faster than a long-term perspective. So if an intermediate term high does break, that could give us potential clues for what's going to happen next on the daily chart, or what's going to happen next on the weekly chart. So therefore, every time your trade gets invalidated, we say that's the cost of business, because it tells us, okay, what's going to happen next. Because every time we frame a failure swing, it's based on logic and reason that this intermediate term high should not break, since it's either rebalance intermediate term high or it's a classical intermediate term high. So it should hold. In a downtrend, you don't want to see highs break. You want to see highs hold. You want to see order blocks hold. And you want to see swing lows break, since these are opposing to the parent order flow. So understanding this will remove that impulsive behavior to revenge trade. So if you can classify your swing points very clearly, and you have complete clarity to frame your swing highs and swing lows off on, if this high breaks, you'll say, okay, that tells me more information, rather than it causing a lot of emotions in you that causes revenge trading. So you can't revenge trade on a framework that's flawed. And if this high breaks, that means this high was flawed. Okay? The framework was flawed. So there's no point on revenge trading on a framework that's flawed. Otherwise, it's dumb trading. So, rules for intermediate term swing points. If the intermediate term swing points breaks, expect that analysis to be flawed. Do not force another trade if this happens. Wait for market structure to get back in sync with your expectations, and that's how you prevent revenge trading and getting angry when you trade and ultimately blowing your trading account up. So now let's talk about short-term swing points. Long-term, intermediate term, and short-term swing points all serve a specific purpose. Long-term swing points give you narrative. Intermediate-term swing points give you framework. Short-term swing points give you entry methods. So let's talk about when you're switching from that intermediate-term perspective into the short-term perspective. So from that day trader's perspective, when you're going from a 1 hour to a 15-minute, okay, switching perspectives. The intermediate-term swing points gives you the framework to use on a short-term perspective. So don't classify swing points on a short-term perspective. The objective of the short-term perspective is just for entry purposes. Okay, so you're not identifying long-term highs and long-term lows on a short-term, right? The only thing you're doing on the short-term is, where's my stop loss? Where's my entry? And do I have enough time to get there? So that's when you look at, okay, how long do I have until London close happens? The end of London close happens? Or when I hit that 16-hour mark or the 15-hour mark, how much time do I have to get to my targets? That's it. But when you're on the intermediate term perspective, that's when you are looking for rebalanced high, classical, or a classical intermediate term high, and gives you a clear structure point to work within, and also a clear objective you can find. So now let's talk about participating in failure swings. Given the framework, the failure swings give us logic and reason to participate on a failure swing. Okay, so the framework is here is like price retraced into this imbalance. We expect that to be an intermediate term high. So if we did retrace, we're going to take action on that. Where can we target? Clean lows here. We must make sure that our entry on the short-term perspective also follows time theory. Otherwise, it's a low probability trade. So, like I've said countless times, price moves in business hours. Those business hours are London, New York. And anything outside of those business hours, you'll see price be inactive. So here we have intermediate term high, breaks lower, taking out the short term low. We know that might offer retracement. If it does, that is an opportunity for us to participate on. Now we know that this retracement here, which is a failure swing, that has logic and reason for us to participate on, because we expect this to be an intermediate term high, which also follows time theory. Okay, so midnight opening, we're expecting price to form a Judas swing. That Judas swing forms an intermediate term high. Price then breaks down with displacement, leaving gaps. This failure swing happens. We're going to take a short. I'm going to put a stop above this intermediate term high because that's a clear invalidation point, right? If it breaks this intermediate term high and closes above this imbalance, that just tells you that the logic and the analysis was flawed. So that's when you have to wait on the sidelines and wait for things to get back aligned with what you think is going to happen. Here you can see two failure swings here. We want to participate on these failure swings because price just printed an intermediate term high. So what we want to do is we want to wait for kill zone. We have a market structure break here with displacement. Price leaves imbalances. We can take action on these failure swings with this imbalance inside a kill zone. So take an entry there. You can put your stop above here, or if you're a very conservative trader and you're scared that it's going to go up again, you want to put it at, okay, where is a clear invalidation point, which is this intermediate term high, because that's the true intermediate. That's the true invalidation area. Okay, If this high broke again, that would mean that your logic and analysis was flawed. So simple strategy, waiting for an intermediate term high, then a market structure shift, leaving a fair value gap inside a kill zone. You take an entry inside that fair value gap, and you have a target here. Bam. That's one strategy you can take, which is the most common one. This is also another common one, which is the optimal trade entry. You have an intermediate term high here, so you know that this high is in place. It gives the framework. So if we do see a market structure shift, we're going to use that range, and we're going to wait for price to hit the sweet spot, which has a fair value gap, by the way. Sweet spot there. You put your stop above this high, and since it's in a time in a kill zone, which follows time theory, we're going to expect that to be a high probability trade. And price displaces down because it's banks and financial institutions are behind this trade, so it displaces down. You can start taking partials at 0.5, 1, 1.5, and 2, all the way until you have the daily close, which is at 15-hour mark. Alright, and that's how you use the long-term perspective, the intermediate-term perspective, and the short-term perspective, and you're classifying all these swing points so that when you do look for entries, it becomes easy. You have so much clarity. You just look for that shift and that fair value gap and that time kill zone to work within. All this becomes so much easy, so much clarity, and it will remove all that overthinking that you'll have if you didn't do any of these steps, right? If you didn't do any of these steps, you would basically have overthinking, or you might second guess your entries, or you might hesitate to enter just because there was not any clarity behind your trading. But all these little swing points gives you framework, and that intermediate term swing high or swing low that you frame a trade upon basically will remove all that overthinking you're going to have when taking that trade. That kill zone also removes all the hesitation because you know that price is going to move within those hours. So all these little factors will just make you a better trader because it gives you clarity. And yeah, I'm super happy to show this to people, but if it wasn't for ICT, then I wouldn't know any of this. So big shout out to my mentor ICT, and yeah, he's the only reason that I'm able to do this and able to show you guys how to do it as well, walk you through the process. But now let's give you the action step. Okay, so how do you use all this information and what to do for, from this point and take action. So what I want you to do now is I want you to start classifying your swing points in your study journal. Alright? Follow the narrative. Otherwise, it's going to be very hard for you to classify these swing points. So the narrative is just that long-term perspective level. Then once you go in the intermediate term and the short term, you start classifying each swing point. So that's all we have for today's video, and I'll catch you in the next one.